Hi CA students, let's revise CA Final AFM Chapter 3 Advanced Capital Budgeting Decisions. Practical question 1. Skylark Airways is planning to acquire a light commercial aircraft for flying class clients at an investment of 50 lakhs. The expected cash flow after tax for the next 3 years is as given. Year 1, Year 2, Year 3 they have given cash flows with the probabilities. So we have to find expected cash flows, expected yearly cash flows. Then the first requirement of question, the company wishes to take into consideration all possible risk factors relating to airline operation. The company wants to know expected NPV of its venture assuming independent probability distribution with a 6% risk-free rate of return. So they are asking us to first calculate expected NPV. First we'll go through that part. This is simple as usual. We have to multiply that cash flow with probability, and then we'll get an expected cash flow, yearly expected cash flows. That yearly expected cash flows will multiply with present value factor. Here they have given 6% risk-free rate of return. Multiplying that, we'll get expected net present value by reducing cash outflow. So they have given cash outflow 50 lakhs. So we are getting a positive NPV of 24 lakhs 97,400. Okay, going up next, they are asking possible deviation in the expected value. So the term possible deviation itself says us to calculate standard deviation. So since possible deviation is asked, first we have to calculate yearly deviations, then we can find out the overall standard deviation for the project. So going with yearly deviations, since we have cash flows, then probability. So first we'll check the expected cash flow. For year 1 it is 27 lakhs. So reducing that, we'll get the difference between the cash flow and the expected cash flow, then squaring it up and then multiplying with the probability. The sum of all these likely possibilities will get the variance. Then root of the variance will get standard deviation. For first year it is 9.241, and for second year it is 9.930, and for third year it is 8.619. Then standard since they are asking the possible deviation in the expected value, we have to find out the standard deviation for the project as well. So going up here, ICAI has given this formula. It is suggestible to use this formula for all the problems wherein they are asking possible deviation for the whole year, and you have 3 different years probabilities with cash flows. So if you people want a separate video on this derivation of this formula, then I can give a video. Otherwise, as of now, we can go with this formula itself. In that video, I'll clearly explain why while discounting it is squared up. As of now, we can go with this. So the standard deviation, I'll give the simple idea. In my previous video I've clearly mentioned that standard deviation is not linear towards time. So when we found out that value at risk VAR formula, VAR for 1 day and VAR for 10 days, we rooted up the time, wherein we calculated VAR for 1 day, and when we calculate VAR for 10 days, we multiplied standard deviation with root of 10. So the same way here also it applies. If it comes to standard deviation, the time is rooted. So while discounting it also, we should not directly discount it with the normal rates. We have to square it up and then discount. Then only we'll get the actual standard deviation. So I'll clearly explain in a separate video if you guys want, but as of now we can go with this formula itself. So we have to just take root of, then variance of the 3 years, then first year divided by whatever discount rates into 2. So for first year 1 into 2, for second year 2 into 2, then for third year 3 into 2, by which we get 14.3696. We can do it in other way also, wherein for year 1 we can just take the standard deviation and then discount it with the year, and then we'll get discounted standard deviation. For 3 years, then we have to square each standard deviation and then add it up and then root. In that case also we'll get the same answer, but we have to always go with ICAI solution, but it's exact same as the same answer. Now the next part of the question was, how would standard deviation of the present value distribution help in capital budgeting decision? This is a theory part. As usual, standard deviation is a measure of dispersion, which is ideally used for checking the volatility of the project or the risk involved in a project. Like that we can explain. So the same theory part they have explained also. You guys can go through that. Thank you.